Welcome to Magnifi Plus, where we help you invest with intelligence, which means with Magnifi, you can now do more than just trade stocks. You can search, you can discover, and invest in the ideas and values that are most important to you using our revolutionary machine learning software. I'm Nicole Lapin, former CNBC, CNN, and Bloomberg anchor, and your host for today. Today's guest is Peter Boockvar, CIO at Bleakley Advisory Group, editor of the Boock Report, and a CNBC contributor. Peter was the chief market analyst for the Lindsay Group, a macroeconomic and market research firm, and he was also a partner at Miller Tabak and Company for 18 years, where he was the equity strategist and a portfolio manager. Welcome, Peter. That is some resume.
Thanks, Nicole, for taking the time to read all of that.
You have seen it all, clearly. Resume is proof of that. This has been a volatile time, to say the least. You sat through the 99, 2000 market. You sat through 08, 09. Can you give us some perspective on what the market looks like today compared to those rough times?
Well, 2001 reminded me a lot of 1999, when in 1999, all the internet stocks were going up by $50 to $100 a day, and just announcing that you were getting into the internet business, your stock would double in a matter of minutes. And 2021 had a very similar feel, particularly in February when we had obviously the meme stock craze, whether it was GameStop, AMC, or others, that just reached this euphoric peak. And then as the year progressed and the air came out of that, reminded me a lot of the year 2000, when the NASDAQ peaked in March 2000, and the market started to narrow in terms of its breadth. All the high flyers in 99 got deflated. The market sort of started to hide in some of the well-known names, which we saw for the back half of 2021. And then 2022, similar to 2001 into 2002, no stock was immune, and the market got around to everybody. The U.S. economy went into recession, and I see very close similarities. Now, there are different similarities, and there are different differences between then and now, between inflation and monetary policy and other macro events. But strictly stock market performance-wise, I see a lot of similarities.
So let's double click on the crypto part of what you were saying. A lot of turbulence in the crypto market lately. We just found this incredible fraud with FTX. Last week, Nouriel Roubini, Dr. Doom, said that crypto and some of its players are an ecosystem that's totally corrupt. We don't know the fallout yet, but do you see value in these cryptocurrencies?
I can't say with any confidence that I see any value just yet. And I think what we've seen is it really comes down to just Bitcoin and Ethereum as sort of the last two legitimate ones standing. I said legitimate, at least for now. I think that will continue to be that way. But it's tough to really put your finger on how much further damage is done and what else is infected. Getting to the 1999 corollary is when there is a bull market, when there is cheap money, every investment looks good. And I think that the crypto craze, which is what it was to the point where it was a religion, also was the beneficiary of quantitative easing, zero rates that blinded investors into a lot of different things. And now that the cost of capital is much higher, the Fed is much tighter, all those blinders have now come off investors. And now we get to see things for what they really are.
Well, there's definitely no more cheap money. You've been known as somewhat of a Fed whisperer over the years. You have this great sense of market conditions and your finger on the pulse of monetary policy. You know, when people were saying that inflation was transitory, you were saying, no, it wasn't. Where do you think the Fed will stop? And what do you think the terminal rate would be?
So after the Fed raises 50 basis points in December, that will take the Fed funds rate to a range of 4.25, 4.5. I don't think they have much left after that. I've actually argued that maybe December could be the last one. Now, from the commentary that we've been hearing, Maybe they'll throw in another 25 basis points in January, maybe one after. But either way, we're coming to the tail end of this interest rate hiking cycle. Inflation definitely has peaked. Goods prices are now rolling over. Services inflation, on the other hand, keep accelerating. So net, while inflation is moderating, I still think that it's going to take time for it to fall notably. And then the question is, well, do we just go back to pre-COVID levels of 1% to 2% that then would allow the Fed to actually start cutting interest rates again? Or are we headed toward a structurally higher rate of inflation of like 3% to 4% when all said and done? And while it's better than the 8% that we have now, it's well above what we're used to pre-COVID, and that would keep interest rates higher for longer. And I think that's the investing scenario and economic scenario that I think we're going to have to get used to. And that it's not a victory just to have the Fed done hiking. There are other mountains to climb here in this bear market.
Like what? What kind of, in your recent newsletter, which was great, by the way, you said that as a lot of people are debating soft landing versus hard landing, bear versus bull market, you're becoming worried about death by 1,000 cuts in the economy and the stock market. So what cut is next?
I think we have to then in 2023 deal with the economic consequences of higher interest rates. And whether you're a potential home buyer that now has to deal with a 7% mortgage rate on top of home prices that are up 40% in 2 years, or you're that small business that borrowed floating rate and your interest expense 2 years ago was 3% and now it's 7.5% if you're lucky, or your credit card rate is now almost 20%, that leads to just slower economic growth. It's going to lead to slower business expansion. It's going to lead to a less amount of businesses getting started because they have to pay higher interest rate that they may not be able to service. It just slows things down. And it's not just in the US, it's of course a global thing to see the rise in interest rates. And with respect to the stock market and just investments in general, well, we're not going back to zero rates in QE for a while. And I mentioned QE because behind the scenes, even if the Fed is done raising short-term interest rates, they're still shrinking their balance sheet, which creates its own sort of tightening headwind for the market. So where is the PE ratio going to end up in this higher rate environment? Well, right now we're trading at 17 times earnings, and I don't think bear markets bottom at 17 times earnings. It's probably going to be less than that. And what's going to be the earnings outlook going to be in this slower economic environment? And I think it's going to be below where current estimates are. So I do think that 2023, economically and investment-wise, is still going to be a bumpy, rougher time than many investors are used to.
Can you lay out the explanation of why you think inflation has peaked?
Well, let's separate out services inflation from goods prices. The 20 years leading into COVID, goods prices averaged zero. And then we had the cyclical spike. You had this flood of demand. Supply side couldn't keep up. But now the supply side is finally caught up to an extent in most areas, not all, but many. You have consumers that have already spent a lot on goods, and they're now seeing a hangover. You're not buying a new exercise machine in your basement. You're not adding another kitchen since you just did it 2 years ago. You just bought a lot of laptops for work from home and learn from home. You're not going to do that again for another couple of years. So goods prices are falling. A lot of big retailers are announcing discounting in electronics, apparel, and anything related to the home. Now, on the other side, services prices, led by rents and medical care, those prices will continue to accelerate. So net, while I do think that the rate of change will continue to slow and we'll end up possibly with a 4 handle next year, maybe even a 3, I don't think we're going back to 1 to 2 for a while.
So do you think moving forward, this is a good time for clients and investors to buy bonds?
Well, finally, you have interest rates to collect, the coupons to get in fixed income land. So I do think that there are some pretty attractive opportunities. You have investment grade bonds that are yielding 6%, and you can do that without taking much duration risk by buying shorter term durations. You can buy the highest rung of high yield, the double Bs, and get almost 10%. So yes, there are opportunities. Now, further out and weaker on the credit quality spectrum, like triple Cs, a lot of bank loans that end up as floating rate bonds and CLOs or other instruments, that I would be much more careful about, and very important to stick to quality right now. And you can buy a short-term 2-year treasury and get a yield of 4.5% and get some attractive munis too. So fixed income land with shorter durations, I believe, are more attractive. Longer term durations, I'm still more suspect on.
So in the equities space, we've seen, of course, interest rate cycle that's been more wild than it has been in 40 years. And given everything we've talked about with interest rates and inflation, as we're putting our money in, as you say, high quality bonds, where should we invest on the equity side, and what kind of asset classes are returning there?
So I think with equities, it's very important to understand that we're in a different ballgame here. The macro backdrop is different. That if you use the playbook that you've been using for the past 5 years, I don't think it's going to work for the prospective 5 years. That means I think value stocks are much more attractive than growthy tech stocks. I think commodity stocks are much more attractive than they've been over the past 5 years, particularly energy, precious metals, even industrial metals like copper stocks. I think if the dollar has topped out because the Fed is getting closer to the end of the rate hiking cycle, you can find opportunities in international markets, which we are, particularly Asian markets, which we like, even emerging market sovereign bonds that are non-dollar denominated are pretty attractive here with high yields that you potentially have a kicker of a weaker dollar. And that just buying Google and Amazon and Apple, while they're all great companies, well, that ship has sailed, and the baton in terms of market leadership is going to be passed to other parts of the market.
So if we zoom in on the currencies part of this, of course, you follow very closely along with the dollar once rates stop rising and the dollar peaks. As we're talking about international investments that you say will be more attractive, is there anything specific that you would suggest us moving our money to?
I think one of the most exciting demographic trends over the coming 10 years is going to be the growing middle class in Asia. And for all of China's problems, for all of the authoritarian government of President Xi, the Chinese middle class is going to double in the next 5 years. The middle class in India is going to skyrocket, in Indonesia, in Vietnam, in Bangladesh. This is where the economic growth is going to be. Markets there have been dead money for 10 years. And I think anybody who can not only locally can take advantage of that, but even in the US or even European companies that can tap into that Asian potential, I think are going to be big beneficiaries, whether it's travel related names, because even the Chinese tourists, once COVID is over there, or at least they decide to finally tolerate it, and the Chinese tourist is unleashed, they like to spend a lot of money. They like to travel, they like to eat out at restaurants, and that's going to be the case for that entire region where these developing markets play catch up to the world's developed markets.
So as we're following the trends of Chinese consumers, what geopolitical events are you focusing on, and where do you think that could impact the market in 2023?
Well, we still have to see, speaking of Asia, how this whole China-Taiwan thing plays out. It's obviously a concern. It would be a disaster for the global economy if China decided to invade Taiwan. Disruption like we would not believe that would affect the entire world, not just that region. That has to be a focus. And how Putin decides to negotiate a peace there in Ukraine, because he's not going to win. And other than a ceasefire of some sort, I'm not sure how this fully ends and the impact that's going to have on energy markets. And while Europe is probably safe in terms of storage levels of natural gas going into this winter, there's a lot of risk for next winter. And have we entered into a structurally higher cost of energy world, which I think we have. But if Putin goes, if he dies tomorrow, maybe we can step away from that.
So with this geopolitical backdrop, and if inflation has peaked, do you think that we're in a recession, entering a recession?
Well, the way I like to look at it is, rather than a yes or no or an on button, off button in terms of the direction of the US economy, is to break it into pieces. The US housing market is in a recession. The US auto sector is probably headed into a recession, particularly the subprime area, where the higher cost of borrowing on top of record high core prices create a problem. The lower income consumer is probably in their own recession as wages are rising at a much slower pace than inflation. The upper end consumer, not yet feeling a recession. You go out to a restaurant on a Saturday night, chances are it's still pretty crowded and they're still traveling and spending money. But whether the economy is in a recession or not, the trajectory of growth is not a one event. It's a progression of things. And I think that just because maybe we're not technically in a recession today doesn't mean we're not heading to one in 2023, because a lot of the things that I'm seeing are pointing to further weakness and a likely contraction in GDP in 2023.
And how far in advance do you think the stock and bond markets have priced that in or discounted that?
Well, the way I look at a bear market is it usually comes in three stages. The first one is we take a lot of the frothy excesses and euphoria out of the market in terms of the sexy names that we saw in 2021, and we take a PE ratio down. And we've done that. We went from 22 times earnings, call it 16 to 17 now. The second phase is, and typically these bear markets happen coincident with monetary tightening. The second phase is, what are the economic and earnings consequences of this rise in interest rates? And I feel like we're really just only beginning to start that second phase. And then the third phase is everyone throws in the towel in markets. No one wants to own a stock again. And that's your bottom. And that's when you need to be buying stocks hand over fist.
What about other hard assets or commodities? You touched on that for a moment. You still like gold?
I still like gold. It's been painful over the past couple of years, particularly 2021. But even 2022, while it's down, it's barely down now. And while it hasn't been that inflation hedge that it has its reputation for, I think that's been because of the very aggressive Fed, the very sharp rise in interest rates, and the dollar. But if I'm right that the Fed's almost done raising interest rates, if I'm right that the dollar is going to start weakening because of that, then I think gold and silver can reassert its place as where people can keep money, because inflation is still going to be above the rate of interest rates. So we're still going to have negative real interest rates. And if the economy continues to weaken, which then can lead to the Fed eventually cutting interest rates, I think gold and silver will benefit in that kind of environment. Because even outside of the US, you look at European Central Bank, they have interest rates at 1 3/4 with inflation at 10. There's still deeply negative real interest rates around the world. That should benefit gold and silver.
What's your prediction for the rest of the year?
Well, the last 5 weeks, it's tough to call because it's just such a short time frame. And there aren't, outside of the Fed meeting in mid-December, where we pretty much know what they're going to do since they've so well telegraphed it, I don't really know of any major catalysts that would cause a rally or even a sell-off. So I just think that we remain in this sort of 3,700 to 4,100 trading range for the next 5 weeks. So a lot of churn, a lot of activity, but really action that gets us nowhere.
Okay, so let's look farther out for the next year, for the next 3 years, for the next 5 years. Where is your head when thinking about the returns for US stocks, for bonds, for emerging markets? How do you view that looking forward?
Well, if you look at the S&P 500, which is still dominated by big cap tech, I wouldn't be surprised over the next 5 to 10 years that was very little upside. Again, because of the dominance of these big companies that really need to grow into their earnings. That said, just as in the 2000s, there were plenty of value opportunities that did well. And keep in mind that bear markets are really the best time to be buying stocks, because the cheaper you pay for something, the better your future returns, and vice versa. So a bear market makes things cheaper, provides better opportunities, and those with longer term time horizons should be taking advantage of this. No one's smart enough to pick a bottom, but if you're buying what you think is a good company that can survive a recession, well, if it gets cheaper, well, then it should become more attractive. And again, the more attractive and cheaper price you pay, the better your future returns. Fixed income, well, today your future returns are certainly much better than where we stood a year ago. or even back in March when rates were still at zero. So a year ago, I would have said that fixed income returns look pretty poor. But now, of course, they certainly look much better with the very sharp rise in interest rates that we've seen.
And then finally, in emerging markets, still cautious, or where is your head with that?
I think emerging markets, as I mentioned earlier, particularly Asian emerging markets, are very attractive, particularly in Southeast Asia. As I mentioned, just this play on this rising middle class, with India probably one of the most exciting growth stories in itself. And I'm also emerging market bonds. We can buy sovereign bonds, get very good yields, and possibly get some currency benefits as well.
So you have been so spot on with your predictions in the past. Super great track record, no nonsense. What is the biggest surprise prediction you can tell us for 2023?
That is a great question. Unfortunately, I don't even know whether this is a surprise. It's probably not a surprise to many who think that maybe the worst is over, that the Fed is done soon raising interest rates and it's all clear. Historically speaking, bear markets don't bottom until after the Fed is well into a rate cutting cycle. So I think the biggest surprise is that this market's still going to grind lower next year and that we have not seen the bottom. Now, again, lower prices will be attractive, but I think it's way too premature to think that the worst is over and that just because the Fed's almost done raising interest rates, that it's all clear. To me, like I said earlier, we're just entering the second phase of this bear market.
Strap in. Anything else you think our listeners, our watchers can know about where to put our money with that in mind?
I think that the key here is time horizon. If you have a long-term time horizon, a bear market is going to create an ocean of opportunities. If you have a big purchase that you have to make within the next year or two, whether it's a kid going to college or it's a wedding, a bar mitzvah, or some other expense like a home that you have put aside money for, it should not be in the stock market. It should be in the bank. It should be in short-term T-bills. It should be in cash equivalents, because the next couple of years are going to be challenging for those with shorter-term time horizons. But like I said, a sea of opportunities for those with longer ones.
Yeah. Keep your blinders on.
And keep some
stuff is on sale.
Too.
That's right. Always great to see you. Thank you so much, Peter.
Thanks, Nicole.
Peter talked about moving money into international markets once the dollar peaks. He also said inflation peaked, which could mean a strong bet on interest rates and looking at directional ETFs. And if you want to do that, you can use Magnifi, which is like Google for investments, to get some suggestions. So take a look at this. It's so simple. I just typed in emerging market ETF into the search bar. And here's what we get. I could sort by fees. I could sort by risk. But I'm sorting right now by return, and you can see the ETFs listed there from DFSE to EEMS to EWX. And of course, if you want to look further into a leveraged ETF to make that directional bet instead of one-on-one bet. Of course, these come with more risks, so keep that in mind, but you can search, I want to buy, let's say, a leveraged ETF for higher interest rates. And the AI understands exactly what I'm looking for. And it gives me these search results now. So I'll sort again by rate of return, and you can see that comes up FCG, PXE, FXN. Such great information today, and most of all, a great way for all of you watching to make better informed investment decisions. For more information on how to invest with intelligence in a volatile market, please visit us at magnifi.com.